Happy Monday to you. My name is Nate Krampe, and I would like to talk a little bit about some thoughts right now. Are we out of the woods? Is the stock market kind of swoons and everything over yet? So after this kind of fast correction from record highs that we've had in the stock market, the S&P 500 index, stocks staged an impressive comeback. Now, the S&P 500 put together its best week in basically since 2013, and it rallied more than 5% from the lows to bring its sessions winning streak to about 6. So this is 6 different sessions. Now this week, we consider what it means to be basically moving forward, including what higher interest rates and rising inflation might mean for stock. So let's kind of dive into some details here. First of all, we have strong fundamentals, and that's fantastic. Now, whether we're out of the woods or not is basically a tough question to answer with confidence, but when we weigh the evidence, it basically appears that the odds are good that the worst is behind us. The stock market's strong fundamentals are supportive, U.S. economic growth is solid, and despite last week's retail sell-off and shortfalls, we were attribute this to temporary factors, consumer, business confidence, things like that. They all remain high. And as personal spending and capital investment are both likely to keep boosting us from the new tax laws, inflation will rise, yes, but it remains relatively low when compared to basically historical averages. So, it is also that this may not be related to a strong January consumer price index data, kind of what we initially suggested due to the weather and any kind of seasonal factors. But here's what we know. Earnings season has been excellent, which had a 15% increase in the stock market, the S&P 500 earnings in the fourth quarter of last year. That is basically an 8% revenue increase, both nicely above our prior expectations. Now, the new tax laws haven't even kicked in yet, which analysts have increased their 2018 earnings for the stock market profits by $10 per share. And this is the S&P 500 when I keep talking about the stock market. Now, that's up nearly 7% since January 1st. And companies are not just starting to announce how much higher their overseas cash they are repatriatizing and back to the United States, and this is due to the new tax laws, and a good portion of the cash is expected to be directed to shares, share repurchases, and that will likely boost the earnings per share. So where do we go from here is kind of what we keep talking about. Let's come back and take a look at the technicals. Now, from basically a technical perspective, and this is kind of the ins and outs of the chart on a daily basis, you can see basically the details that are some indicators supporting the view that the worst may be over. Now, the bullish trend is intact. The S&P 500 broke back above its 50-day moving average on Thursday. This is February 15th now, and it managed to close above the 200-day throughout the latest correction. Now, the 200-day moving average remains upward sloping, and this indicates a continued bullish technical trend that you can see in this chart. So what that means is this, that if we're above the 200-day, if we're above some of these things, and these are all just technical related instances, that's a positive sign. And the more time we spend above that, the more positive things become. So evidence of capitulation selling has occurred. Now, that was on October 5th, not October, that'd be in a little bit, a while ago, but February 5th, when the Dow Jones Industrial Average was up basically after a huge drop of almost 1,500 points, but then we only closed down about 1,100 points, or 4.6%. And the number of the S&P 500 stock declines relative to the those that were advancing was greater than 40 to 1. Basically, what this means This is indicative of extreme panic selling, and the low percentage of stocks that were above the 50-day moving average was below 20%. This is another indicator that the extreme selling pressure was occurring. And what happens at this point in time is that reversals tend to be quick. So basically what this happens is that they're what we call very oversold, and we can have a huge increase that happens. And that actually did happen when we entered this kind of oversold period. And based upon the relative strength that we keep talking about, the stock market subsequently reversed and moved strongly higher, just like I had talked about. Now, this is while maintaining the bullish trend, a pattern that has historically proved to be bullish technical signals. So that is a little more history on kind of the technical side of things. So here's the thing. We had a strong rebound, and when that happens, historically, the weekly stock market prices close above their interweek lows. It has been more bullish. So this happened on February 9th. Now combining that with solid fundamentals and the technical evidence suggests to us that the recent lows may hold. Now, however, this rule does not bring about the unlikelihood that we may return to normal volatility and that we may have more days that are up and down 1%, and we could even be considering a 5 or 10% pullback over the course of the year. That may not be unheard of, but that's not going to relatively change things if that happens on the technical and the more so the fundamental outlook. So let's kind of figure out where we're going. Should you be worried about rising rates, everything that we've been talking about? And with that, the latest downdraft was triggered primarily by accelerating wage growth, and this sparked fears of rising inflations, and a more aggressive Federal Reserve. Now that's what we've been talking about with the Federal Reserve, maybe having to raise interest rates more than expected, and we still think that kind of going back to where we have been historically, that stocks will continue to do well with inflation and with these higher interest rates. Now, like I said before, this does illustrate in the chart that historically when the 10-year yield has been above 5%, the stock market and interest rates have trended to move together. This is a positive correlation, and what that means is that stocks go up despite raising interest rates. Now, when rates are relatively low, basically these raising rates usually indicate improving growth, which is a good thing. And as what we have basically found as evident in today, this year and also this month. So higher interest rate levels, rising interest rates have basically tended to spook stock investors as the Feds get more aggressive and borrowing costs rise. And with the 10-year Treasury, the yield not having even gone above 3%, basically during all of this market moving that we have done, we still think that there may be ways to go before the levels of these interest rates actually start to hurt our economic activity, and that the stock market in general, even with those relative kind of reverses and all the things that have happened with the lower interest rate levels that when we've seen historically, we still think that we can have some growth. So the expectation would be, if rates potentially do spike again, because of the speed at which rates move can be important to the level. It is something to watch, like always, but we continue to expect only basically a gradual increase in the benchmark, which is the 10-year Treasury yield. And the year-end forecast that we've kind of been putting numbers on is about 2.75 up to about 3.25%, and we're right in the middle of that range right now. So, what about basically higher inflation? Let's look at the relationship between higher inflation and the stock market. This chart basically shows that the low inflation level, the price to earnings, is what we call the PE ratio for the stock market. The S&P 500 tends to be higher, and vice versa with CPI. and that's right about 2%. Now we think stock valuations at current levels are about 17 times the next 12 months earnings estimates, and this is very reasonable. And if the S&P 500 delivers consensus earnings numbers for 2018, and this is basically $157 per share, then it would only take the PEs to move up slightly over 2018 to get to our fair value target around about 2,900 at year end. And from kind of where we have been, that would represent another between 4 and 6% upside. Now, keep this in mind. The average price to earnings when inflation is below 3% has been over 18 times. And if we're taking a look at current inflation levels and we see stock valuations basically being quite reasonable, especially when you consider the solid economic and profit backdrops. One more time, where do we go from here? We maintain our positive outlook. And with the stocks, despite the recent volatility and everything else that has occurred, the fundamentals remain good and strong. And as we have written before in our outlook for 2018, the combination of improving business fundamentals and the fiscal legislation, sustained momentum in the economy, and even the equity market itself in the coming year has the potential to continue to keep going beyond where it's been. And years of dependence on the largest of the monetary policymakers, the investors can focus on fiscal levels. And we believe that will support consumption and spur new business investments over the next couple of years. So in terms of kind of investor positioning, consistent with our view of kind of where we're thinking for 2018, we actually do favor what we call cyclical equity exposure. Now this is small companies, and we call those small caps. They may benefit from the new tax laws due to relatively higher tax burden that has been kind of reduced, and we believe the value style of investing may get a boost from fiscal legislation as well. And with the value names poised to benefit from tax cuts and reduced regulation, basically notably financials. And meanwhile, the industrial sector may benefit from the combination of lower taxes, 100% of the expenses, higher U.S. government defense spending, and the acceleration of the global growth. The technology sector is also poised to benefit from the solid global growth as well. So there's a large amount of profits held overseas that now have the ability to come back to the U.S. and be repatriatized, and that provides a lot of attraction. Now there's a lot of positives. Focus on those and have a great day. Thanks for watching.